at another form of long-term debt, which are notes. The accounting for notes is almost identical to what it is for bonds. But there's at least one kind of note that we deal with, actually probably two scenarios we deal with notes more commonly. The first one we're going to deal with is when we're exchanging a note for an asset, and the second one is when we're doing something called an installment note. And so you could do those with bonds as well, but they're more commonly done with notes, so we'll talk about them with regard to notes. So long-term notes, long-term note, cash borrowed from a bank with a promissory note, obviously, that's where the name comes from. Present value techniques are used for valuation and interest recognition, exactly the same way as with bonds. Less common to have discounted premiums since they're usually issued at the market rate. So usually these are issued by a financial institution on a particular date. They figure out the market rate as of that instant and they issue it at the same time. And so that's why, in general, there's going to be less premiums and discounts associated with notes, because there's not that waiting time between when we print all these bonds and when we actually sell them. Because of that time lag, you normally can't get it right at the market rate. You get somewhere close, but not exactly. So for long-term notes, they're less likely to have premiums or discounts, but they certainly can. And I think we will do an example of one here in just a second that does have one. So our example, notes exchanged for assets or services. The value of the asset or service exchange for the note establishes the market rate. All right, so this is one of those times, and we talked about one earlier in the semester, about when we're exchanging two things, and we use the value of one of them to help us determine the value of the other. Because whenever we have a transaction, an exchange of goods, in accounting, we assume that the things that are being exchanged are equal in value, right? That's an assumption that we make everywhere. And so we're going to use that assumption to help us here when we have an exchange of goods, an exchange for a note exchange for an asset. So the value of the asset or service exchange for the note establishes the market rate. The economic essence of a transaction should prevail over its outward appearance, substance over form. So there are some cases where, for example, you go to a car dealership and they give you 0% interest. Well, are they really giving you 0% interest? No, they're just increasing the price that you pay of the car originally, and they're making up for it that way. So it's not really 0% interest. So the exchange is still going to be the price of the car, and then we're going to compare that to the price that you're paying, and those things have to be equal. So in many cases, we're going to ignore whatever the interest rate is of this note, and we're going to take the value of the asset, and that will tell us what the interest rate of the note must be. So it's the, as it says right here, where is it? Establishes the market rate, or it's in another word for I can't think of anyway. We'll just say it establishes the market rate. So here's our example. Orbital Inc. purchased a packaging labeling machine from its business by issuing an 8%, $200,000 two-year note that requires interest to be paid semi-annually. The machine could have been purchased at a cash price of $180,000. All right, so we could either buy this machine for $180,000 cash, or we get this $200,000 note, a two-year note, and we're paying interest at 8%. So, do we put the asset on our books at $200,000? No, because that is not what it's actually worth. And 8% is not what we're paying on this note, really. So what we're really getting is an asset worth what? $180,000. So that's going to be the value that we put on our books for the asset. So we're going to, and we're going to do it for both the buyer and the seller, as you've seen previously. So for the buyer, they're going to put on their books this property, plant, equipment at the $180,000, just as you indicated, $180,000. And then we're also going to leave a space, and we're going to put a note payable onto our books for $200,000. And what's going to be the difference? It's going to be a discount. The difference is a discount. So we're going to have a discount of $20,000. So what is the carrying value of this note? $180,000. It's just being issued at a discount. And so we can actually figure out what that market rate of interest actually is. I will not require you to do this on the exam because you can't do it with a table. You can do it with a financial calculator, but I'm not going to require everyone to have a financial calculator, so I won't require you to do this portion on the exam, but for purposes of demonstration, we'll talk through it. Actually, the other side first. So for the seller, they're going to have an investment of $200,000 with a discount, $20,000, and sales revenue of $180,000. Because this person really wants to have sales revenue of $200,000, but they can't do that. That's not really what's happening in this particular case. They really only have sales revenue of $180,000. They're selling something worth $180,000. And incidentally, there would be a cost of goods sold and an inventory reduction here, but we're going to ignore because we don't have those numbers. All right, so now we need to figure out what the market rate of interest is. Yes?
Why do we call it an investment and not like a
So,
receivable?
a note receivable, same thing. Yeah, you call that a note receivable, that'd be fine. Yeah. But you're essentially an investor. You are lending them money is what you're doing. Note receivable would be just fine as well, though. All right, so just like with bonds, we're going to use the effective interest method. So we need to know, first of all, what the carrying value is. We know what the carrying value is. It's $180,000. The second thing we need to know is the market rate of interest. Well, we don't have that. Okay? But we do know a number of things. We know the present value of the future cash flows. What's the present value of the future cash flows? So what's the present value of the future cash flows for this thing?
180.
180, right? It's the issuance price. That's always the present value of future cash flows. The issuance price is not cash, it's a put on equipment, but same thing. The present value of future cash flows is $180,000. We also know what the payments are going to be. It's a 2-year note. We can figure out the interest payments. And they're going to be, well, let's figure it out. It's $200,000, and it is 8%, and it's semi-annual. So that's going to give us $8,000 payments. We know the payments, and so we can, if we had a financial calculator, we could put in the present value, we could put in the interest payments, we could put in the interest rate, and we could solve for the interest rate. That's the thing we need. And this happens to end up being just under 14%. And so it's going to be, for 6 months, it's 6.95%. And so for 12 months, that would be what? 13.9% annually. And so we always want to think about, does that make sense? 13.9% is the market rate. The stated rate is what? 8%. And so it should be issued at a discount because we are paying less than what the market rate is. We're actually paying almost 14% interest on this, not the 8% that the stated rate says. Does that make sense? Okay, do me a favor and with big circle and marks and say, Professor Blunck gave me this number, I don't have to figure this out for the exam. Otherwise I get 5 emails right before the exam saying, how did I get this? So write that really big for me. So you don't wonder where you got that 6.95%, I gave it to you. But you could solve for it using a financial calculator. And this is going to give you the amount of interest, expense, and revenue. And so for the buyer, they're going to record interest expense of $12,510. They're going to pay out cash of the $8,000 we already figured out, and they're going to amortize the discount much more quickly because it's only 4 years or 2 years. 4, 5, 10. And then similarly for the seller, Going to receive cash of $8,000. It's going to reduce the discount, $4,510. You're going to have the interest or revenue, $12,510. And then if we went to the next period, just like we did for bonds, we would update the carrying amount, we would multiply that by the market rate of interest to get us our interest expense and interest revenue, and it would work exactly the same way as bonds, just like we already know how to do. So you see why we still need to understand those bonds to be able to do these, because it's the same thing.
So for test purposes, you're gonna give us the effective or the implicit rate? Or you're gonna just give us the amount of the expense?
To be honest, I don't remember how I asked this on the exam, so I do not know the answer to that. But I will not require you to figure out this number, I know that for sure. Because you can't with the table.
So you'd have to give us one or the other?
I'm going to have to give you one or the other, that's correct. Yeah, that is correct. All right. Any other questions on this? So the key point to take away from this is, when an asset is exchanged for a note or any kind of liability, oftentimes the value of the asset tells us what the effective rate of interest is on the note or the bond or whatever the long-term liability is, just like we did right here. Because many times people giving us, lending us money are lying about what the interest rate actually is. When you go into the car dealership, you're not actually paying 0% interest. I'm sorry, you're just not. You aren't. You're paying more for the vehicle than what you could pay if you just paid them cash right now. I promise. Otherwise, they'd be really dumb. They would not do that. All right, installment notes. This is the second example with notes that we're going to look at. You may not know it by the name installment note, but all of you probably have dealt with installment notes before, because these are what your mortgage is, your car payments, your student loans. These are all installment notes. Installment notes essentially are notes that get paid back with equal payments, such that when you make your last payment, you pay the last of the interest expense, and the last of the principal gets paid off, and you're done when you get to the end. So that's the way car, home, and student loans all work. So we're going to look at the accounting for those. They're pretty straightforward. One reason, and we could easily skip this particular problem in this chapter if we wanted to, because it's pretty straightforward. Probably all of you could figure this out. But when we get to leases, you're going to see that the leases, one type of them, look exactly like this. And so to prepare us for leases, we're doing this example here. So installment notes. A note with equal payments during the payment period with no balloon payment maturity. Examples, car loans and mortgages. Cash payments are calculated using present value tables or the calculator. Here's our example. This company borrowed $500,000 from a bank at 6% using an installment note. Z company will pay installment payments monthly over 12 months to pay off the loan. So this is just a 12-month loan, 12 payments, one per month. At the end of each month, the first one happens at the end of the very first month. So the first thing we need to do with this problem is figure out what the actual cash payments are going to be, because it's not given to us. But we can figure out what that's going to be, and this is a case where we can use the tables to figure this number out, or use a financial calculator, so you will be required to do this on the exam. So the first thing we wanted to figure out is what are going to be, what am I doing here? All right, I don't know what I'm doing. What is that? I'm just trying to figure out what I'm doing in my notes here, and they don't make any sense. I'm just going to ignore my notes because they don't make sense. So what we're going to do is we know that the present value of an annuity equals the payment times a present value factor. Okay? And so in this case, we know what the present value of this annuity is. In other words, we're going to make 12 equal payments, and if we present value them all back to today, they must equal what number? 500,000. So we know the present value of the annuity equals 500,000. We don't know what the payments is. That's going to be X for us. we can figure out the present value factor because we know the details of what's going on. 12 periods, oh, I know what, no, that still doesn't make sense. I don't know what my notes are doing. 12 periods, because it's 12 months, and 6% paid over the 12-month period. So what is it going to be per month? 0.5%. So I believe in your tables in the textbook they don't have a 0.5%, but if you did have a table with a 0.5%, which many tables do have 0.5%, you would find that this factor has to be 11.619. Actually, does anyone have their textbook with them? Wow. Could you look to see if there's a 0.5% on there? You got like a skinny book. Is that only half the book?
Yeah, it's the second half.
Huh. I
No,
really had that.
stops at 1.
Okay, so they don't have 0.5%. All right. Well, pretend like that 0.5% on there. Obviously, whatever percentage I give you on the exam have to be on the table that I give you. But if you did, if it was 0.5%, it was 12 periods, you get this number. So we know this and we know this. Now we just solve for x. So take 500,000 divided by 11.619. X has to be 43,033. In other words, the only payment made at the end of each month that will pay this thing off plus interest is $43,033. If it was $1 more, you'd be paying too much. $1 less, you would not be paying enough off, and you still have principal left at the end. So 43,033 will pay off this $500,000 loan with 12 equal payments and earning 6% annually, 0.5% per month. So 43,033 is our payments. And so the initial entry for the borrower, they're going to receive cash of $500,000. And they're going to have a note payable of $500,000. And the lender is going to have an investment, or you could call this a note receivable, will be fine as well. Investment, $500,000. And they're going to pay out cash of $500,000. All right, now we're going to have our first payment. We've already figured out the amount of cash that we're going to pay out. Oh, now I figured out what that. I had this line on here that I couldn't figure out what that was doing, and it's not until way down here that I use it. I don't know why it's way up there. All right, so for the borrower, they're going to make a cash payment of the number we figured out, which is 43,033. The effective interest method is still in play here, as is true with all debt. So let's use the effective interest method, and that is going to be the carrying value of 500,000 multiplied by the market rate of interest, and it's only half of a month, it's only 1 month, so it's 0.5%. And that's going to give us a payment, interest expense of $2,500. And so we're going to debit interest expense of $2,500. Are we going to amortize a discount or a premium?
No,
No, what are we doing?
we're reducing notes payable.
We are reducing the principal, right? We are reducing the note payable or the investment, depending on which side we're on. That's exactly right. So think about your car payments or your mortgage payments. First, the money goes to the interest, and then everything left goes to reduce how much you owe on the note. This is exactly what happens here. And so we're going to have $2,500 go to interest, and the remainder is going to reduce our note payable, and that's going to be $40,533. And similarly for the lender, they're going to receive cash of $43,033. They're going to have interest revenue of $2,500, and their investment is going to be reduced because they just got cash out of it. And that's going to be for $45,33.
So I'm not sure how you got 35.
This guy right here?
Yeah.
So this is the effective interest method. This is the carrying value of the note multiplied by the market rate of interest multiplied by the time period. So Or we could also write this as 500,000 times 6% times 1 divided by 12 is the same thing. So that's just the effective interest method in play once again for the 50th time in the last 3 weeks. So I teach a IFRS class to master students, and I asked them what the effective interest method meant. They've all been through a whole bunch of accounting classes. Nobody could tell me what it was. I was very disappointed. All of you will be able to tell someone what that is. Is that true? You all know, because I've said it to you probably 20 times by now. Repetition means anything. You all know what that is at this point. And some of those were my students, so I was very disappointed. My past students that I taught this class to. Only a couple, but still very disappointing. You all know, I'm sure. All right, the second payment. The second payment, the new carrying value is going to be 500,000 minus the amount of the note or the investment we reduced, and so that is going to be 459, 467 multiplied by 0.5%, and that is going to give us interest expense of 2297, and so we're going to have interest expense of 2297. Our note payable is going to be reduced by 4736. Cash is going to be the same number, 43033, because the cash number stays the same every single time, right? Same cash payment. Your car payment is the same, your mortgage payment is the same, your student loan payment is the same. Probably none of you are paying student loans at this point. You will be in the future. Oh, maybe some of you. Many of you will be in the future. I'm still paying student loans. Yeah.
Oh, what does NIP stand for?
Oh,
that's
note
note
payable,
payable.
it's a slash, sorry. Ha! All right,
Carrying value, 459, 467, where did you get that?
that is the 500,000 minus the principal that was paid off. So minus the principal.
Total was
4533. And as you see on the next page, we're going to fill out a big table with this. But before we do that, I will do the journal entry for the opposite side, that second payment, and then we'll fill in this big table. And I tell myself every semester that I'm going to reduce this down to 6 months, and I always forget. So I gotta write